Hey everyone, welcome back to the channel. I'm Doug the Retirement Guy, and today we're taking an educated look at a group of ETFs that don't seem to get much attention as they're bigger names like YieldMax and Roundhill. And based on the historical charts, I don't see any clear signs of long-term NAV decline during the period reviewed of some of these funds. We'll walk through how their strategies work, how they're structured, and what available data shows as far as the better understanding and the different approach that these take in the ETF world. But before we start, I gotta give a huge thank out to all of our Patreon supporters, our YouTube subscribers, and all of our YouTube channel members. We thank you so deeply. This helps keep the channel possible. And if you're new here, feel free to hit that subscribe button. Turn on the notifications. Hit that bell notification. You don't want to miss one of our educated breakdowns of ETF funds. Let's get into today's video. Important disclaimer. This video is for educational and informational purposes only. This is not financial advice or investment advice. Past performances do not guarantee future results. Always consult a licensed financial professional before making financial decisions. All right, let's get into today's discussion on the ETFs. So who are the hidden ETFs and where we're looking at today? When most people talk about weekly paying ETFs, they immediately mention YieldMax or Roundhill or GraniteShares. But another issuer that has been growing quietly in this space that we're going to talk about is RexShares. Their lineup of weekly paying ETFs has expanded, and they recently introduced 5 new funds. Today we're going to take an educated look at how RexShares structures the ETFs, what's their framework, and how the earlier funds have behaved based on available data. Now, this is not about recommending an ETF. This is simply about understanding the mechanisms behind the different ETFs from RexShares. What makes RexShares structure actually different? Well, RexShare uses a 50-50 structural blend on its ETFs. So on one, they use an income-seeking side of 50%. So half the portfolio typically uses covered calls, writing short-term or out-of-the-money options, which can potentially generate income depending on market conditions and volatility. The second side is the growth exposure side. The other half generally remains uncovered. This means it participates full in price changes in the underlying asset, both up and down because of the leverage use. There is no cap placed on this side of the fund. Now, the target exposure, some of the Rex funds use approximately 1.25 exposure, which aims to increase the sensitivity to price movements. This isn't a leveraged ETF in the traditional sense, but it does attempt to increase the participation. Now, none of this is guaranteed outcomes. It simply describes their structural design that they've developed. Now, looking at the original 4 RexShares ETFs, the earlier group of ETFs are launched in mid-2025 and include the Tesla linked ETF, the NVIDIA linked ETF, the MicroStrategies linked ETF, and the Coinbase linked ETF. Each one of these use the same 50-50 framework, but tied to a different underlying stock. So when we take a look at this, based on the available data, the Tesla and the NVIDIA linked ETFs show positive returns during certain periods. And MicroStrategies and Coinbase have experienced declines due to their underlying stock movement. This is not an indication that will happen next. It's simply showing the underlying assets behavior significantly impacting the results. So I show you a little simpler system here of the Tesla and the NVIDIA linked ETF showing their positive returns during those certain periods. You can see our 15.33% and 0.87% in growth only. And then you see the MicroStrategy and the Coinbase ETF experience those declines due to the underlying stock movement. Now we'll wrap this together. You can see the Tesla and the NVIDIA showing you the price return and the total returns, all based on the current data that we were able to work with. Now, with that, based on the historical charts, I do not see any clear signs of long-term NAV decline during the period of either one of these two funds. When we show the MicroStrategy and the Coinbase ETFs, the historical charts do show that we have long-term NAV decline during the periods that were reviewed, which is why we say the underlying asset is not performing. Now let's talk about the new RecShares funds that they have. The new lineup includes underlying assets from Robinhood, Peloton, CoreWeaver, Eli Lilly, and Walmart. These span tech, finance and tech, healthcare, and retail, a more diversified set of sectors. Now, the initial price data shows mixed results, which is normal for newly launched ETFs. Some have pulled back alongside the market movements, while others have shown early strengths. So when we take a look at the data provided that we are able to show, the initial price data, as we say, you see the mixed results. With Robinhood up 205%, the largest, best performer. While Peloton at 152, Weaver and Eli Lilly right in the mid-range, and Walmart being the slowest growth. So let me show you again the underlying performance in a little bit easier chart to read. So the initial price data shows that mixed results. You can see even with the strong Robinhood underlying performance, the HOII is down 17.51%. The Eli Lilly is at 15.48%, which is our number one winner, and Walmart has that 0.95% growth. Very similar to what we're seeing from the older funds in the data that we have. So let's do dividend and distribution considerations. The earlier funds like NVIDIA and Tesla have a longer history of distributions, while the newer ETFs are still in their early stages. Distribution levels can vary and should always be viewed in caution since yields change based on market movements and options activity. So with the current information that we have and the data that we were given, you can see NVIDIA and Tesla having 105% yield and 78% respectively. Then we look at the Eli Lilly and Walmart side, and they're at 42% and 59%. So again, we have two very strong up-and-coming ETFs potentially. Now, as we saw, the earlier funds have a longer distribution history, allowing for more data to review. The newer funds are still building their track records. Yields normally fluctuate based on market valuation, option premium levels, underlying stock movement, fund structure. These yields can change at any time and should never be implemented as a guaranteed income. So you really have to learn what goes on, which is the educational takeaway of the option enhanced ETFs. So one, the underlying stock behavior matters the most. If underlying stock declines sharply, option premiums may not offset that downturn. Higher volatility can create higher option premiums. Covered call strategies can limit that upside. These strategies are more complex than traditional ETFs. They involve derivatives, premiums, and volatility exposure. Diversifying the underlying sectors can create different outcome patterns. Tech behaves differently than healthcare or retail. So remember the pros and cons of these type of funds. The potential for weekly income, the growth potential of that 50% holding of uncapped, the leverage returns of that 1.25 return, and a balanced, unique combination of income and growth. But the risks are always that underlying asset dependency, the volatility, the underperforming risk, and the strategy complexity. These are the things you always have to remember. So let's now talk about a real world educational portfolio example. I'm going to open up my actual portfolio that I have of RecShares. So for demonstration purposes only, here is my personal portfolio. I put equal dollar allocation into the original 4 ETFs over that period of about 5 months right now. And you can see the total value decline during the market conditions where we've lost $599 or 14.99%. When you take and add in the distributions that we've contributed to, so $937 of dividends have come in, or 23.44%, for a total return of $337 or 8.44% over those 5 months. Now, this is example. This is not intended as investment advice or guidance. This is simply what I personally have invested into to show you what has happened. Now, 2 weeks ago, I added to a new portfolio and started this, and the same thing. The total value of the 5 new funds that I purchased has had a decline during the market correction of $392 or 7.85%. The dividend income, however, has contributed $69.23 or 1.38% for a total return decline of $358 or 7.16% over the past 2 weeks. So I operate these two as 2 separate portfolios, but together you can see I'm virtually even, about $20 in the hole so far, with time under my belt. So the final educational thoughts, RecShares structure is interesting because it blends that income-seeking covered calls, the growth exposure, and the potential increased participation through targeted exposures, a rules-based and transparent system. Whether an ETF performs well or poorly depending heavily on the underlying assets, the market conditions, the volatility, and timing. 2 of their ETFs have shown periods of positive total returns while others have experienced declines. The newer ETFs are too early in their life cycles to draw conclusions and takeaways. Understanding the structure of the underlying company is essential before making any decisions. So with that, I want to thank you all today for watching. Give me your comments. Tell me what you think of the RecShares. I know we've talked to them on this channel many times before, but let me know. Hit that comments down below.
Thank you for watching.